In this presentation, we will take a look at cost of goods sold as it relates to a sole proprietorship reporting on a Schedule C. We're going to be focusing up here in terms of our income tax equation in the income section, remembering that it's going to be supported by a Schedule C, the Schedule C having an income statement related to the sole proprietorship, which includes income and expenses, such as the cost of goods sold, which is basically a deduction, but the net income would flow through to the first page of the 1040, which is represented by this income tax equation included in the income section. Here's the first page of the 1040. We would be concentrating on line 7A, which would be supported by the Schedule 1, on line 3, which would be supported by the Schedule C. Cost of goods sold. If you make or buy goods to sell, you can deduct the cost of goods sold from your gross receipts on Schedule C. However, to determine these costs, you must value your inventory at the beginning and end of each tax year. So in other words, the cost of goods sold would apply if we sell inventory. So if we're actually selling items, if we're selling goods as opposed to having a service business, which we would have no goods but would be making money through the service that we provide. If we have the inventory, we typically would be calculating the cost of goods sold, being able to deduct the cost of goods sold. To do that, however, the IRS wants us to show the calculation for cost of goods sold, which is basically the beginning inventory plus the purchases minus the ending inventory, giving the cost of goods sold. That means we need the balance sheet accounts. Beginning inventory balance is basically a balance sheet and asset account, and the ending inventory balance sheet account. We don't typically report the balance sheet accounts when we have a Schedule C business because we're not showing the balance sheet. We're only showing the income statement on the Schedule C. However, we need these balance sheet accounts for inventory for the calculation of the cost of goods sold. This chapter applies to you if you are a manufacturer, wholesaler, or retailer, or if you are engaged in any business that makes, buys, or sells goods to produce income. This chapter does not apply to a personal service business such as the business of a doctor, lawyer, carpenter, or painter. However, if you work in a personal service business and also sell or charge for the material and supplies normally used in the business, in your business, this chapter applies to you. The cost of goods sold calculation basically looks like this. We have the line 35, inventory at beginning of the year. If different from last year closing inventory, attach explanation. So in other words, this is going to be a mandatory beginning inventory, basically the balance sheet amount here. Now, if you filed last year and you had the Schedule C, you would have the ending inventory that was reported to them down here on line 41, and they're going to expect that that ending inventory ties out to the beginning inventory. If those two things don't tie out, then that would be a kind of a red flag, I guess, that they could question that because you would expect those two things to tie out. The beginning inventory for the current year should tie out to the ending inventory for the prior year. Then we have the purchase less cost of items withdrawn for personal use. Then 37, cost of labor. Do not include any amounts paid to yourself. Then we have the materials and supplies, other costs. So these are all going to be the things that would be increasing the costs. And typically, like if you're a merchandising company, you would think you would have basically the purchases because you would just be buying inventory, marking it up, and selling it in that case. So you'd have the beginning inventory plus the purchases, and that would give you the amount available for sale. It's often called, if you're talking about financial accounting, that would be lined up on line 40 here. And then you would take the ending inventory, so the ending inventory at the end of the year, and if you subtract that out to the amount that was available for the year, that would give you the cost of goods sold. Now, if you manufacture your inventory, if you make the inventory, then not only the cost of the materials will be involved in it, but the cost of the labor will be included in it, as well as possibly other costs, such as possibly overhead, that would be included in it. So if you're making the inventory, then you'd have basically these items. If you're just buying and selling, marking up, and selling inventory, then you'd have these line items. Now remember, the cost of goods sold equations, basically, again, that we're kind of backing into the expense account related to the cost of goods sold. We're going to do that by looking at the balance sheet accounts, the difference between the balance sheet accounts. So we've got the beginning inventory plus what we purchased during the year, and that's going to give us the amount available. Then if we count how much is left at the end of the year, this is kind of like a periodic type system calculation. If we see how much is left at the end of the year, the difference between what we could have sold throughout the year, beginning inventory plus purchases, minus what is left at the end of the year, is the amount that we sold, which would be the cost of goods sold, the actual expense related to the inventory. This will typically be, of course, a huge expense if our business is one that we sell inventory. You would think that the cost of goods sold would typically be the largest expense for a business that makes all their revenue through the selling of inventory. Now, also note that in practice, if you're looking at the information trying to say, I don't know if I have all these numbers, how to figure that out. Well, if you did the tax return last year, you know what the beginning number is because it ties out to last year's ending number. So you know what that is. You're going to look at the tax return. Okay, we have to use line 41 as the beginning number. You may not really know what the purchases are because you have all the purchases, but you'd have to go to the accounting system to look at what the purchases are. But you do know what the ending inventory is because you have that your accounting system. If you just look at the balance sheet and you have an accounting system like a software or something, you'd have the ending inventory and or you can count it basically at the end of the time period. So you should know what the ending inventory is. And oftentimes, if you're using the software, it will give you the cost of goods sold calculation when you generate the income statement. So it'll give you the cost of goods sold typically. So if you're using software to basically do it, you may basically easily be able to see the beginning inventory. It's going to be there from the last year and from the prior year financial statement. You may see pretty easily the ending inventory on the balance sheet, and you may see easily the cost of goods sold, which would be on the income statement. You may not see exactly the purchases that would line up exactly the way you would think them to line up. So that one, if you know all the rest of these, you can do the equation, right? Beginning inventory plus purchases minus the ending inventory is cost of goods sold. We don't know one variable, so we can use our algebra to figure out the purchases if that were indeed the case.